Welcome to this explainer. We're jumping right in today because we've got a fascinating deep dive into the Indian economy. We're going to be contrasting the highly visible, flashy global diplomacy of recent years with the raw macroeconomic realities happening back at home. To do this, we're using the classic iceberg model. You know the concept, right? What you see floating above the water is only a tiny fraction of the whole picture. Our goal today is to dive beneath the surface and uncover the massive structural forces that are actually driving the economy. Here's our roadmap for today. Optics versus economic reality, the trade deficit trap, declining foreign investment, corporate expansion abroad, the critical minerals race, and finally, market or superpower. Let's get into it. And to make sure we keep things completely objective, everything we're unpacking today comes directly from a critical analysis by senior journalist Chavi Prabhakar Rao, published by iView Bharat. We aren't here to take political sides at all. We're just laying out the data and the arguments presented in his review to see exactly what the source material is telling us. Part 1. Optics versus economic reality, the tip of the iceberg. Since 2014, India's global image has been, well, incredibly visible. Over 80 foreign visits, huge global summits, top civilian honors. It projects this massive aura of international strength and acceptance. But the source asks a really crucial question. Have these tours actually strengthened the domestic economy? Because when you look at the ground reality, manufacturing hasn't exploded quite like those Make in India campaigns promised. Exports are kind of stagnant compared to surging imports, and the rupee is weakening. So it begs the question, are these strategic partnerships building an economic powerhouse, or are they just pitching a giant consumer market for global corporations to sell into? Section 2. The trade deficit trap. Now we're sinking below the surface. And sinking below the surface brings us to a frankly staggering number, $250 billion. Looking ahead to 2025-26, India's imports are projected to hit somewhere between $700 and $720 billion. But exports? They're only expected to hover around $440 to $450 billion. That leaves a projected trade deficit of over $250 billion. Simply put, the country is spending way more dollars than it's bringing in. And when a country does that year after year, it sets off a chain reaction across the whole economy. Because when you spend that much more than you earn, the local currency takes a serious hit. Back in 2021, the rupee was sitting around 73 to the US dollar, but it's been steadily slipping. Market projections now suggest it could slide to 89, or maybe even 90, if global pressures keep up. And why does that actually matter to you and me? Because a weak rupee means everything imported, like fuel, electronics, fertilizers, gets way more expensive. That drives up inflation, and ultimately it's everyday middle-class families who really feel the squeeze. Now, you'll often hear calls for citizens to buy less gold or use less fuel to help out the economy. But let's look at the actual numbers. Gold imports only make up about 0.7% of the GDP. Crude oil imports, on the other hand, they cost nearly $132 to $140 billion recently, which is roughly 4.5% of GDP. So while the spotlight often lands on consumer behavior, specifically jewelry buyers, the data totally spells it out. Massive oil dependency is the real structural drain on foreign exchange, not gold. All right, Section 3, declining foreign investment. Let's look at those deep currents. Foreign direct investment, or FDI, is a huge indicator of global investor confidence. So if India is consistently billed as one of the fastest growing economies on the planet, you'd absolutely expect investment to be skyrocketing, right? Well, actually, FDI dropped from $59.6 billion in 2020-2021 down to $44.4 billion in 2023-24. We really have to ask, despite all those diplomatic optics and global summits we talked about, why is foreign capital flow actually slowing down? It actually gets a bit more concerning when you zoom in on net FDI. Between April and December of 2023, net FDI reportedly plummeted by nearly 55%, dropping below $10 billion. That's a massive drop. It suggests foreign firms might be hitting the brakes on expansion or even pulling their profits out of India. And it's not just a one-off thing. Foreign portfolio investors pulled nearly $17 billion out of Indian equity markets in 2022 alone. That definitely raises some tough questions about long-term global confidence in the market. Section 4, corporate expansion abroad. Let's look outward. So, it turns out capital flight isn't just a foreign phenomenon. There's this significant trend of India's very own corporate giants expanding outward. We're talking about heavy hitters, the Adani Group, Mukesh Ambani's enterprises, the Tata Group, Mittal, Jindal. They're all aggressively investing in the US, Europe, Africa, and the Middle East. Now, sure, global expansion is a totally normal step for massive conglomerates, But when it's happening right against a backdrop of declining foreign investment at home, that paints a very specific picture. The journalist argues that this aggressive outward push, and I'm quoting directly here, reflects concerns about domestic profitability, policy uncertainty, and market limitations within India. Even with all the international scrutiny some of these overseas commitments get, India's economic elite seem to be heavily prioritizing investments abroad. According to the source, this fuels a lot of public skepticism about governance. I mean, if the biggest local players are hunting for growth somewhere else, what exactly does that say about the true health of the domestic market? Moving to Section 5, the critical minerals race. This is the looming glacier. Zooming out to the global stage, we hit a massive, looming challenge for the future. The global economic battleground has totally shifted. It's not just about who controls the oil anymore. It is all about critical minerals. We're talking elements like lithium, cobalt, nickel, graphite, and rare earths. Just think about it. You literally cannot build electric vehicles, semiconductors, renewable energy tech, or even advanced defense systems without these materials. They are the absolute backbone of a next-generation economy. And here's what is frankly a bit terrifying for Western supply chains. China utterly dominates this space. They saw this strategic reality coming like 2 decades ago. They aggressively secured mining rates across Africa and Latin America, absolutely locking down the supply chains. Today, China controls a staggering 85 to 90% of global rare earth processing and over 70% of the battery supply chain market. They practically own the whole chessboard. So, how's everyone else reacting? Well, the US and Europe are scrambling. They're rapidly launching massive infrastructure partnerships across Africa to break that reliance on China. But the analysis points out a real strategic vacuum for India. While Western countries are playing the long game for these minerals, India seemingly lacks a comprehensive long-term strategy. Instead, they often treat short-term crude oil deals with Gulf nations as huge diplomatic wins. But as the source highlights, that doesn't really solve the problem of securing the critical industrial resources we'll need for the future. Which brings us to Section 6, Market or Superpower, the final destination. This brings us right to the culmination of our explainer. Based on the source material, there are 4 absolutely non-negotiable structural challenges India has to tackle. Number 1, secure those critical mineral supply chains. 2, actually strengthen domestic manufacturing beyond just catchy slogans. 3, boost real investor confidence to reverse that FDI drop. And 4, cut down on the excessive import dependence that's bleeding foreign exchange reserves. Because if those things don't happen, the source warns that all those grand trade agreements will just flood the country with foreign products, instead of actually exporting Indian innovation to the world. So, we'll leave you with this final, provocative thought. Real national strength isn't just about ceremonial honors abroad. It's measured by a strong currency, stable investments, and true strategic economic independence. The next decade is going to be incredibly revealing. It will definitively show us whether India can overcome these structural hurdles and emerge as a true production-driven powerhouse, or if it's destined to remain a massive consumption-driven market designed to enrich stronger global economies. Thanks for joining me for this explainer. Until next time, always remember to keep looking beneath the surface.